Housing cannot become dramatically more valuable and dramatically more affordable at the same time. Yet those are the two promises repeated to almost every generation. Every family should be able to afford a home. Every homeowner should watch that home rise in value. Imagine a house priced at $300,000. A few years later, it is worth $600,000. The owner appears $300,000 richer. The next family now needs a larger deposit, a larger mortgage, more interest, and years of extra work. The same number becomes a victory on one side of the door and a lock on the other. By the end, the contradiction will be clear. We will follow the money through homeowners, banks, investors, and government. Then we will see why housing policy keeps promising affordability while protecting the prices that make affordability impossible. The answer is not a secret meeting between homeowners, banks, developers, and government. It is more ordinary than that. Each group can act alone. Each can have a reasonable explanation, yet their incentives often point toward the same result. Prices stay high, scarcity survives, buyers borrow more, and the contradiction remains hidden in plain sight. Start with the house on the table. A television is useful, but when televisions become cheaper, nobody calls it a crisis. Food is essential, and when food prices fall, families feel relief. But when home prices fall, headlines warn that wealth is being destroyed. That reaction reveals the first document in our file. A home is not treated only as shelter. It is shelter, collateral, forced savings, retirement security, and inheritance, and often the largest asset a family owns. Federal Reserve survey data show that the median net housing value of homeowners rose 44% between 2019 and 2022, after inflation. That was real financial progress for millions of owners. It also widened the gate for anyone arriving later. Housing is unusual because people cannot simply decide they no longer need it. A share can rise without denying another person a bedroom. Land in a useful location cannot be copied like a share certificate. When its price rises, somebody must pay, rent, inherit, move, or go without. Follow one sale from beginning to end. Money moves from the buyer to the owner. The deed moves in the opposite direction. There is no mysterious third pile of wealth. A higher selling price is paid by the next household, usually with a larger loan. Now open the second file. It is labeled Scarcity. Most people support affordable housing in the abstract. The conflict appears when the proposed homes receive an address. An apartment building near detached houses. A duplex on a quiet street. Smaller lots. Fewer parking spaces. A taller building near a train station. Each project can bring legitimate concerns. Traffic, schools, construction noise, shadows, infrastructure, neighborhood character. Residents are allowed to care about those things. But restrictions also reduce how many people may live on valuable land. Federal Reserve research finds that supply constraints have sizable effects on house prices. The mechanism is simple. More people want access to an area. The number of homes responds slowly, or not at all. Buyers compete for what remains. Scarcity becomes valuable to the person already holding the key. This does not prove every zoning objection is dishonest. It proves that a homeowner can defend a sincere neighborhood preference while also protecting an asset. Motive may differ. The financial effect can be the same. That is how a system can behave like a conspiracy without requiring one. Now consider the 5 groups surrounding every transaction. The homeowner sees equity and retirement. The bank sees a larger mortgage. The real estate agent may see a commission linked to the sale price. The local government sees a valuable tax base, although the exact tax effect depends on local rules. The investor sees rent and appreciation. No secret handshake is required. When prices rise, several balance sheets look stronger at once. When prices fall, lenders worry about collateral, owners feel poorer, sales slow, projects become harder to finance, and elected officials hear from voters. The people asked to make housing cheaper are surrounded by institutions that have adapted to expensive housing. Now the system offers a solution. It rarely says, lower the price. It says, help the buyer reach the price. Many policies labeled affordable focus on smaller down payments, tax credits, government guarantees, down payment assistance, and cheaper credit. These programs can be life-changing for one family. That matters. A buyer who lacked a deposit may finally get a home. But across the whole market, a dangerous question appears. Are we making the house cheaper or helping more buyers borrow enough to pay an expensive price. If 10 families can each bid $300,000, the seller faces one market. If assistance lets them bid $330,000 but no new house appears, the extra purchasing power can flow into the price. The buyer receives help. The seller may capture part of its value. The bank finances a larger balance. The public announcement says affordability improved, while the price tag quietly moves again. Lower interest rates can create a similar illusion. A lower rate reduces the monthly payment on a given loan. That is real. But it can also let buyers qualify for larger loans. When many buyers gain borrowing power and supply stays tight, they can bid against one another. Financing changes how much money reaches the auction. It does not create another house. Then rates rise. The old prices do not always fall enough to compensate. New buyers can face the worst combination: elevated prices and expensive debt. Existing owners with low fixed rates may avoid moving because replacing their mortgage would cost more. Federal Reserve research estimates that mortgage rate lock-in explained 44% of the decline in mortgage borrower mobility from 2021 to 2022. Fewer owners move. Fewer homes reach the market. The door narrows again. Now follow the consequences away from the sale sign. In 2023, more than 21 million renter households spent over 30% of their income on housing. That was almost half of renter households measured by the Census Bureau. High purchase prices do not remain inside the ownership market. They can keep people renting longer. More demand presses on a limited rental supply. A landlord buying at a high price may seek a higher rent to make the numbers work. The renter pays more and saves a deposit more slowly. The loop is quiet. Expensive homes create more long-term renters. More rental pressure makes saving harder. The delayed buyer returns later to an even higher gate. This is also a generational sorting machine. People who bought earlier gained years of appreciation. People with parents able to help with a deposit entered sooner. People who inherited property may cross without a mortgage at all. People without those advantages must approach with wages and debt. The Federal Reserve reported in 2026 that among adults under 60, those earning more than $100,000 had a homeownership rate more than 3 times that of adults earning below $50,000. Income matters. Timing matters. Family wealth matters. A market described as a ladder can begin to resemble a drawbridge. But now we must open the file that weakens our own case. Homeowners are not simply villains guarding a treasure room. Most did not design this system. They saved a deposit, accepted decades of debt, paid taxes, repaired roofs, and took the risk that prices might fall. They were told, often correctly, that ownership could provide stability, protection from future rent increases, and a way to build equity. For many families, the home is the retirement plan because no better plan was available. If policy suddenly forced prices down, recent buyers could owe more than their homes were worth. Older owners could lose the cushion they expected to use in retirement. Construction could slow. Financial stress could spread. That defense explains why price stability matters. It does not explain why homes must deliver extraordinary gains forever. There is a difference between preserving value and requiring each generation to pay far more than the last. A safe home can build equity without becoming a permanent wealth machine. The conflict begins when appreciation must repeatedly outrun incomes. Return to the house now worth $600,000. The owner appears $300,000 richer. But if every nearby home also doubled, selling does not automatically improve the owner's life. They still need somewhere to live. To turn the gain into spendable wealth, the owner must sell and move somewhere cheaper, downsize, borrow against the house, rent it to somebody else, or pass it to an heir. Some housing wealth is therefore real but trapped. It is attached to the rising replacement cost of the same shelter. The gain is clearest for someone who owns more housing than they need. An investor with several properties can sell one without losing a home. An ordinary owner selling one expensive house to buy another may simply exchange one inflated price for another. Behind that price sits an even quieter asset: land. The building gets older, paint fades, pipes corrode, roofs leak. Yet the property can become more valuable because jobs arrived, a school improved, a station opened, a road was built, or zoning kept new homes out. The owner may have maintained the structure. The surrounding community may have created much of the location value. Follow a publicly funded rail line across a city. Near each station, better access can raise surrounding land values. Public money improves the location, while private deeds capture much of the gain. This does not make ownership illegitimate. It raises the question hidden inside the ledger. When public investment increases private land value, who created the wealth, and who should benefit from it? We have now reached the room behind the public story. The housing crisis is not only a shortage, a banking problem, or a failure to offer enough buyer assistance. It is a political choice between goals that cannot all be maximized. Rapid appreciation rewards existing owners and investors. Stable prices preserve value without demanding endless escalation. Broad affordability requires more homes where people need them, less protected scarcity, or prices and rents growing more slowly than incomes. Using home ownership as the national retirement system creates pressure to defend prices. Treating housing primarily as shelter requires accepting that it may become a less spectacular investment. There are ways to reduce the collision without destroying household security. Build more homes in places with high demand. Allow different types and sizes. Protect renters while supply catches up. Target assistance where it expands access without merely inflating bids. Tax or recapture some land value created by public investment. Strengthen retirement systems so one house does not have to carry a family's entire future. None is painless. Every real solution changes who receives value, who absorbs risk, or who gets access. That is why the easiest policy is another promise. Affordable homes for the young, rising values for owners, no visible loser, no difficult vote. But the house on the table still has two sides. When its price doubles, the owner has not done something wrong. The buyer has not failed. The number simply reveals which promise the system honored first. The housing crisis may not be proof that the system is broken. It may be the predictable result of a system protecting existing property wealth while promising affordable shelter to everyone waiting outside. So ask the final question. If your home can only become a great investment by becoming less affordable to the next family, what exactly are we investing in? Question the story. Follow the money. Find the truth.